Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And our macro risk marathon that we've been on this entire week approaches its zenith. We have the last big piece of data that is going to inform this narrative that we've been looking at all week and ostensibly longer than that, about to cross the wires. And of course, what we're talking about is the April U.S. jobs report. So what we're going to do here is we're going to break down what's expected and then go directly into how this fits in with what the Fed told us earlier in the week, with the economic data as it's been coming out in recent days and weeks, and go straight into here is how markets might react. Shock of shocks. Investors appear focused on recession risk, and that may color the response from stocks, from the dollar, from yields, and give us perhaps a very different dynamic than what we've been used to over the past year and a half. So let's jump right in. On the expectations front, we're looking for a slowdown in hiring, down to 185,000 jobs added. That's relative to 236,000 in March. Unemployment rate seen going up to 3.6 from 3.5%. No changes expected in labor force participation or in average hourly earnings growth, which is, of course, wages. So wage growth seen holding steady. The two, obviously, most closely watched pieces here are going to be the monthly change in payrolls and the number that we're going to get for the unemployment rate. There, it looks like we're going to get, for the latter metric, near the top of the range, which tops out at about 3.7%, basically all through last year. So we would have to go back basically over a year to get out of this range. So it doesn't look like we're going to get anything too crazy there. The hiring pace is a meaningful climb down, though. 185 is the lowest number that we will have seen since the post-COVID recovery in the second half of 2020. So this is looking, by all accounts, like a significant downturn. And if we consider where this fits within the range of U.S. economic outcomes, we can see, indeed, U.S. economic data has been tending to surprise more and more toward a weaker direction. Now, I say that so qualified because we are still above zero on this city economic surprise index. What that means is that we still have economic data outcomes that tend to print better than median expectations. And those expectations are gathered by big aggregators like a Bloomberg or a Reuters. They then publish median forecasts. That's what we mean when the market says XYZ thing is expected to be ABC number. And then when it's not, the markets go, oh, well, it was higher or lower than expected. It's those median forecasts that define, quote, what is expected. And so what Citi does, very helpfully, I might add, hats off to them, is publish a whole range of indicators where they look at how data performs relative to expectations. When it's positive surprises, the index goes up. When it's negative surprises, the index go down. Helpfully, it's scaled by volatility. So if the disparity in expectations and realized outcomes actually drives markets to move, the index goes up more or less, depending on how much movement, and goes up or down, obviously, depending on if the surprise is higher or lower. All of which is to say, when we're above zero, data still tends to be surprising on the top side more than the downside. But as you can see, most recently, there's been significant compression in the magnitude of those upside surprises, which tells you that there is a loss of economic momentum in the US. And we are increasingly getting back close to zero. As we go there, you can see the economic cycle rolling over. And that, of course, would be consistent with an NFP number that's heading lower as well. Earlier this week, we saw the publication of ISM activity surveys. This is from the Institute of Supply Management. And what I've isolated here are the employment components of those surveys, both for the service sector and the manufacturing sector. These work as Purchasing Manager Index or PMI data work. So 50 is the center line. 50 itself is no growth, no contraction. Above 50 is growth. Under 50 is contraction. The further you go above or below, the faster the expansion or contraction. So in this case, what we see is that obviously during COVID, we had a dramatic hit to employment. It was way below 50. Then we got a lot of stimulus. It climbed back up, hit a peak somewhere between the second half of 2020 and the first half of 2021, depending. You can see that manufacturing peaked a little bit before services did. And since then, we have had trending downward. And where we find ourselves now is that basically neither one of them is growing. They're both essentially at 50. Manufacturing has popped a little bit. Services has cooled over the past several months. The trends, though, are unmistakable, and neither at this point seems to be showing expansion. Job openings data that we saw published earlier this week and to assess that the U.S. labor market might be rolling over. So if we look at the current setting, we got 9.5, a little bit more, million job openings. That's the lowest since April of 2021. So clearly, there appears to be a sense that labor demand is actually easing off at this point. And of course, what that factors into is this calculus that we've been looking at very closely, and I'll go through this not so fast so that we can remind ourselves what we're looking at here. But this, of course, is the main conundrum in the labor market as it currently stands, and how it is that unemployment rates are so low, even though the economy appears to be rolling over, and really the driver of what the Fed has been doing. So what we have here in the dark line is the U.S. labor force. So that's labor supply. That's the number of people either in work or looking for work, and that are, of course, eligible. So this does not include, let's say, minors. Then the red line is U.S. labor demand. And this is an estimate that is derived in looking at the number of people already in work and that job openings number, which is this. In other words, what this is saying is here's the number of people working, and then here's the number of people that companies want to be working. And job openings, as we just saw, have fallen to a 2-year low. So the wedge between these two things, the degree to which demand has outstripped supply, should be narrowing, and indeed it is. We can see that going into this this period currently, labor demand has arguably flatlined, or maybe close to a year ago, whereas labor supply continues growing. And so what we end up with, if we take the difference between the two, is this situation here. The bars there represent the distance between these two lines. So you can see that during COVID, where supply of labor, because everybody has been sent home and everything is locked down, significantly outstrips demand. And then as we get into 2021, the situation flips. What we see now is that that imbalance is essentially reversing on inflation. Not surprisingly, when the mismatch started to build, there was a situation where there was a lot more demand than supply. You can see that here, the red line crossing over the blue one and extending well above it. That, of course, feeds inflation, because how do employers compete for scarce labor? Same way that buyers at a supermarket would compete for scarce apples, let's say, on price. They're willing to pay more. And so, not surprisingly, this mismatch has been feeding inflation. And what the Fed has been doing is raising interest rates to cool economic growth such that this dynamic is reversed. And in large part, that's exactly what we're seeing here. The latest numbers with this job openings data that we saw this week give us the lowest shortfall that we've seen since September of 2021. So again, not quite 2 years, let's call it a year and a half. So there certainly seems to be a rolling over of some sort happening in the U.S. labor market. That's with the ISM data showing us that the trend has been toward weakening. That's with job openings at the lowest in 2 years. That's with the general tendency of U.S. economic data to surprise down recently, or at least to surprise higher at a compressing margin, and just knocking on the door of starting to surprise down. All of this seems to paint a picture of deteriorating economic fundamentals starting to bite in the labor market, which is ostensibly one of the laggier parts of the economy, because, of course, once you get enough economic weakness that you're talking about layoffs, that you're talking about reducing hiring, that you're talking about weakness in the labor market, there is enough concern amongst employers that they would be willing to go through that. Because, of course, going through layoffs is difficult. Rehiring once demand returns, also very difficult. And so we have a situation where if employers are willing to start to shed workforces, they don't anticipate that we are going to have a brief period of weakness or a shallow one. They start to see real consternation. And indeed, this is precisely what we see here in the wake of this week's Fed policy announcement, where the central bank confirmed for markets that it is on the cusp, if not confirming yet, but on the cusp of flipping to the other side of the policy cycle. So far, the Fed is saying, we're going to stop hiking here. Now, they're not committing to saying that that next meeting they won't hike. But of course, they never do. This kind of change in rhetoric, though, where we saw come out of the Fed statement references to the need for more tightening, and instead saw those replaced with a more neutral statement saying, in contemplating if we need more tightening, we're going to consider XYZ factors like the lag in policy absorption, et cetera, et cetera. All of which suggests that the Fed expects that the amount of pain now facing the economy will be sufficient to hit its policy target without it hiking more. That as the hikes it's done up to this point continue to work through into real economic conditions on the ground, that will be enough pain. The target will get reached. What's very interesting here is that the markets seem to agree. If we look at the 2-year break-even rate, which is something that we've pointed out quite a lot, tends to lead CPI and PCE by about 2 months, that is already at 2% as of today. What this is saying is that within the Fed's policy window, within 2 years' time, we're going to get back on target. Now, of course, currency PPI is at 5. Current PCE is at 4.2. So, how is it that over these next 2 years, we are going to squeeze between 2 and 3% of inflation out of the system, depending on which benchmark you want to use, if the Fed has stopped raising rates? Well, ostensibly, it's because the economic pain from the hikes that have already occurred will be sufficient to give us that outcome. If we look at the way that this has been reflected in Fed policy expectations, the first thing to note here, most impressively, is there is now a negative sign in front of every single one of these numbers. In the number of hikes column, in the percent hike cut column, in the implied rate delta column, all of that is suggesting that the way forward from here is easing as far as the markets are concerned. So it seems like both the Fed and markets have looked at this cumulative turn, have started to see the pain show up in the place that the Fed wanted to see it, the most difficult one to drive inflation out of, the labor market, and feels like it is on the path to victory for its inflation fight, at least. Why is the labor market, of course, so difficult to squeeze inflation out of? Just as an aside, well, if what you're talking about is the mending of supply chains and the reason why the widgets you're going to sell are more expensive is because you can't get enough of them, or your deliveries of them are inconsistent because of some sort of COVID-era disruptions or a changing of supply chains because of the trade war with China, et cetera, et cetera. Once those things are resolved, or at least adjusted for, the price of widgets ought to go down because your cost structure ought to come back in. That's different than hiring because you generally don't adjust wages down when inflation is reduced. The only way to get a cheaper labor force, really, especially when you're talking about, of course, permanent rather than contract-based or part-time labor, is to have layoffs and then to rehire at a lower rate. So the Fed has been waiting to see that what it's doing has gotten to the labor market. And ostensibly it has, which is perhaps why it now feels comfortable to say, okay, we don't need to do anymore. We are now on a tightening autopilot that will be enough. And so you look now and you see the markets recognize it. So at this stage, it looks like we have stasis baked in for June, but by July, we're already looking at a significant possibility of a cut. 18 basis points of a cut already priced in. By September, one cut is fully in the market, and there's about a half a percent a chance that we're going to have more. So if we look here currently, you can see in that implied rate delta column, by July, 18 basis points of a 25 basis point cut are in. By September, all 25 are there, and the number is 39, which means we are 39 basis points en route to 50. So there's already a significant amount of a second cut baked in. By November, that second cut is in. You can see there the implied rate delta, 67 basis points. So 50 basis points already there, approaching 75. By December, 75 is already there, approaching 100 at 93. Which means the markets have at this point fully priced in 3 cuts starting in July or so, and about a 73% chance of a fourth. And then that fourth cut is fully priced in by the time you get to January. Such that we get from rates at 5 now to rates in the 3.75 to 4 range come January, and 4.25 to 4 range come December. These kinds of changes in expectations don't just occur because the market thinks everything is fine, obviously. And they read the Fed earlier this week as looking at this clearly, as saying, we see that there's more pain. Fed, of course, said they're not going to cut. That's something that you might expect. But that they've stopped and that they've even acknowledged that a recession is probably on the horizon, albeit they think a shallow one, seems to suggest that indeed the markets and the central bank are of a mind. And what they're setting up for is weakness. How the markets then respond to that weakness seems to have evolved. What we're looking at here, and this is a chart that we've been looking at quite a lot here in the past week and a half or two, is the difference in which markets used to respond when Fed rate hike expectations fall and respond at this point. So consider that before SVB, what you had was a build in Fed policy expectations toward a more hawkish setting, which risk sentiment didn't like. The orange bars here, yellowish orange bars, are the S&P 500, which is the ES future here. The dashed line here is just a 5-day moving average, just to give us a kind of sense of the trend that's a little bit easier to digest. So here is the build, here's the decline. Obviously, through the SVB fiasco here, policy expectations collapsed, risk continued to fall. Then through the rebuild, what we see is things normalize, and then right around here, there appears to be a mismatch. Risk returns to where it was, about 4,200 on the S&P. Policy expectations notably do not come back to where they were before this. They're back to where they were before the build with that positive economic data run in February. And the relationship now has become not inverse, but direct. So as we get a drift down in Fed policy expectations, stocks are actually going lower, which is the inverse of what we saw here. And arguably, the reason why that's happening is because the markets are now concerned with recession rather than speculating on the Fed doing fewer hikes being good news. That is, they would be applying less of a headwind to an economy that was trying to grow. And of course, where the prospect of more hikes was good news for the dollar, good news for yields, bad news for risk. Because it would suggest that those headwinds might get stronger. This is a very different dynamic now. Now the market is saying the Fed moving to cuts, the Fed moving to an easier, more dovish policy setting in relative terms, that's bad news for risk. Because this is not about what the Fed does at the next meeting. This is about a recessionary turn in the business cycle. You can see a similar evolution in the way that the dollar has behaved, as we just alluded to. What we're seeing here is as those Fed policy expectations now go down, the dollar is gaining, which is fundamentally different than what we saw again before the SVB episode. Here we are. The Fed outlook gets more hawkish, the dollar gains. The banking crisis shakes up the Etch-a-Sketch, resets expectations, resets markets to some extent. And where we end up now is a very different environment, where now it's not rising Fed policy expectations, but falling Fed policy expectations that give us a stronger dollar. And of course, what that speaks to is the dynamic that we never get tired of discussing here on Macro Money, the dollar smile framework. Now, just to quickly recap for the perhaps less than initiated here, what you're seeing on the bottom is the spread between U.S. economic growth and other major economies, the G7. When the spread is negative, that means the U.S. is underperforming. When it's positive, that means it's outperforming other similar economies. On the vertical axis, we have the U.S. dollar, which is just in this case the DX future. What you see before SVB, here, before that big decline in the red line, is what you might see on the right side of this smile, which is that strong U.S. growth is driving expectations for higher interest rates. That is a tailwind for the dollar because, as we've said many times, a rising cost of borrowing for some is also a rising income from lending for others, for the counterparty. And so when rates on dollars rise, as it happens for currencies more generally, the appeal of owning them because they can be lent out at better rates rises. People buy the currencies, the price goes up. That's an environment in which the U.S. is expected to do well. That is a broadly risk-on environment and speaks to a general preference for return over safety, for risk-taking in the economy, above and beyond anything specific to the dollar. When we look at the other side, and what we're seeing now looks much more like the left side, where the dollar gains as there is economic deterioration, because markets are not looking at the return qualities, but at the liquidity haven ones. If there is going to be a big economic downturn and assets start to fall because their return prospects deteriorate and markets become more risk averse in general, they go to cash out. What's the cash of choice? Well, not surprisingly, it's the dollar because it's the most liquid and the most able to absorb all of that cashing out without a tremendous amount of volatility, and incidentally, without a tremendous amount of pushback from U.S. officials, which is distinct from most other officials around the world. If you were to drive up the yen a lot, if you were to drive the euro up a lot, if you were to drive up the Chinese yuan a lot, officialdom in those places might balk and resist, because that hurts those countries' export prospects. In the U.S., we don't really care. We're a consumption-led economy. And so what we're looking at here, a domestic consumption-led economy, I should say, what we're looking at here then is a situation where that the dollar is starting to do well in risk aversion, that stocks are starting to do poorly when Fed rate hike odds decline, seems to all speak to there is recession risk that the market perceives and is beginning to value safety over returns. All of which speaks to a general risk-off bias across assets, not just in the dollar. And of course, that makes for an asymmetric set of outcomes for this upcoming jobs report. If, in fact, we are going to get a weak number in line with the recent trend in outcomes relative to expectations and all of the headwinds gathering for the labor market that we've just discussed here, that would be confirmation of a dynamic already underway. And so what you likely get is weaker stocks as Fed rate hike odds deteriorate further, or the Fed outlook deteriorates further. Not really very many hikes to speak of at the moment. More so cuts now. And the dollar might be expected to get stronger in that kind of an environment. It seems, since the market is already on this page, that it would take a tremendous amount to surprise on the upside, because ostensibly, what would that mean? Certainly wouldn't mean that the Fed is going to be changing its mind and going back to aggressive hikes. That seems unlikely. So the bar to an upside surprise is probably very, very high, in so much as it would need to be very high to meaningfully change the landscape. Whereas if it's somewhere in line with expectations, or worse, which has been, as we've just said, a growing sort of tendency, well, then all of these concerns get amplified, and the results are more risk aversion really across markets and across asset classes. And that seems like a much more probable way that this goes than is the alternative. Doesn't make the alternative impossible, of course. A meaningfully upside surprise on NFP, given the Fed has basically tied its hands now, might actually be greeted with some cheer. No more rate hikes, but a stronger than expected labor market. That would be good news. But the surprise would need to be meaningful enough to alter the mountain of growing evidence that the labor market is flagging for the market's perception lens of the economy. It would need to adjust how markets view all of that evidence in a meaningful enough way to change the landscape and alter these dynamics. And so the bar to something like that feels very high as relative to the bar for something going in the opposite direction that feeds this dynamic and is ultimately bad for risk. And that is Macro Money for today. It's also our last show for this week. We're here Monday through Thursday every week right after overtime, where I cover with our good friend Chris Vecchio, head of Futures and Forex here at tastylive, that day's events and review how they contextualize us going forward. I'm also going to be on, as ever, with Chris for Futures Power Hour tomorrow, as every Friday. So we're going to be breaking down this NFP data at that at that point, see what comes out. I'm also on with Tom and Tony on Sundays for First Call as markets start to come alive for the week. Outside of those shows, I am opining on Twitter at Ilya Spivak. So come check that out as well. Thanks very much for joining me. See you next week. Good luck out there.